What's up, everybody? My name is Demetri Kofinas, and you're listening to Hidden Forces, a podcast that inspires investors, entrepreneurs, and everyday citizens to challenge consensus narratives and to learn how to think critically about the systems of power shaping our world. My guest on this week's episode is Lev Menand, an associate professor of law at Columbia Law School who has worked as an economist at the Federal Reserve Bank of New York and as a senior advisor to both the Deputy Secretary of the Treasury and the Assistant Secretary for Financial Institutions. He joins me today to talk about the extremely important and timely subject of money, specifically US dollars, and the evolution of what we once would have called banking, but which has transformed over the years into a kind of Frankenstein's monster whose appendages and doppelgängers reach into the deepest recesses of the global economy. Dollar balances and dollar-based lending by institutions not regulated by the Federal Reserve, what we broadly refer to as the shadow banking system, have grown so large over the years that no one, not even the Fed, can actually quantify them. For most of us, awareness of just how dangerously complex the modern banking system has become was made clear 14 years ago with the onset of what we now call the global financial crisis, a supposedly once-in-a-lifetime event that almost repeated itself during the early days of the COVID-19 pandemic, when the Fed once again came to the rescue of markets by stepping into the breach, creating an additional $3 trillion, 3 times what it conjured in the fall of 2008, to stop yet another financial panic that once again threatened to bring down the global financial system. Panics like these ultimately stem from a fear or inability on the part of financial counterparties to settle claims and honor liabilities. And with the Fed now raising interest rates more aggressively than it has in almost 30 years, the question that many investors, economists, and policymakers around the world are asking themselves, or should be asking themselves, is what is the likelihood that the events we experienced in 2008 and most recently in 2020, crises of liquidity and in some cases solvency, repeat themselves today? My objective in bringing you this conversation is to provide you with a foundational framework for understanding the forces responsible for driving crises of liquidity in the international dollar system during a time when those forces are growing stronger and stronger. In the process, you're going to learn about the plumbing of the financial system, the evolution of the euro-dollar market, repos, money market funds, and so much more. The majority of that conversation takes place in the second hour of today's episode, which is available to premium subscribers only. You can access that part of the conversation, as well as the transcripts and intelligence reports to each episode by visiting our website at hiddenforces.io, selecting the episode you're interested in, and clicking on the premium extras, where you can then sign up to one of our premium content tiers. And with that, please enjoy this week's episode with my guest, Lev Menand. Lev Menand, welcome to Hidden Forces.
Thank you for having me.
It's my pleasure, Lev. You're also one of those guests who's super easy. You solve your own technical problems. So I'm very excited to have you on. I've told you twice now how much I enjoyed your book. I think it's uniquely good. I've read so many books on monetary policy in my life, so many. Some of those are focused on trying to explain monetary policy. The vast majority explain it by default or inadvertently. This was, I think, the best and the most current. And also, it's such a short book, which means that it's accessible for people. I want to ask you about the book. I want to talk about the shadow banking system, money markets, the euro-dollar market, reforming the Fed, shadow banking, et cetera, all that great stuff. But before we do, I would love to understand a little bit about you and how you got to be such a nerd and such a geek and interested in monetary policy, which is, let's be honest, it's geeky.
Yeah, it is. I think there was a lot of randomness in it. I graduated from college in 2009 into the worst job market in a generation. And I was lucky to get a job working at the New York Fed, of all places, doing economic research. And then I was lucky again to be assigned to the financial intermediation group at the New York Fed and to work on stress tests of the banking system, the very first stress tests. And I was grappling with what was going on with the world around me. And I've been trying to make sense of it in some ways ever since. And so this book, which is 10, 15 years after that, is really a story about that and what's happened as a result of that dislocation. And I think that dislocation, the 2008 dislocation, is shaping so many things around us, not just monetary policy and the Fed, but many parts of our lives. And because of how my life intersected with that event, I got interested in it, and I've been thinking about it ever since.
Well, I mean, you represent so many people in America today. I mean, you're the kind of prime example because you graduated right into the financial crisis, but so many millennials were impacted by that, and the job market was impacted by that, and it's had long-term consequences. So I'm very jealous that you had an opportunity to work at the New York Fed in 2009. I'm curious what kind of access you got. Were you able to get? Like how easy was it to use that opportunity to learn about the plumbing of the system?
So in the beginning, I was at the bottom of the totem pole, and I was in the economic research division. And my access came from the fact that there was a need for people to run regressions and do data analysis on bank balance sheet data in order to produce the first comprehensive capital assessment and review. And I was one of a few people who was on a small team of economists working on developing a set of models to estimate capital gaps in the banking system, the need that banks might have to raise more equity financing in the capital markets. And that was my window in. I got to see a lot of interesting things as part of that process in terms of how banks estimated their own capital gaps and the different approaches of the different large banks to the whole exercise. By the end of my time there, I was able to go down to DC. I was detailed to the Financial Stability Oversight Council, which is an interagency, sort of super agency set up by the Dodd-Frank Act, which was Congress's and Washington's response to the 2008 crisis, which was passed in July of 2010. And so they set up this super agency to monitor financial stability, and it didn't have any staff in the beginning because it was brand new. And so a lot of people from the New York Fed were detailed down to help produce the first annual report on financial stability for the United States, which I worked on. And I would say that experience was very formative for me because that was a very small team, and we were trying to grapple with the full extent of risks and vulnerabilities. It's an exercise that really no one in the U.S. had ever seriously engaged in before. Other countries had financial stability reports. The U.S. didn't. And that was also, like the stress testing, sort of got me interested in the issues that I sort of try to address in the book.
What was the kind of revelation that you came to during this period? What did you learn that was most important? And how did all of that go into not just informing what you write about in your book, but which motivated you to write your book, whose title is The Fed Unbound?
Yeah, so I think during this period, I only took one step towards the book. And that step was recognizing that the U.S. government had been, in many respects, asleep at the switch, asleep at the wheel going into 2008. And it wasn't an accident. To the extent there was leadership at the government level, it was consciously closing its eyes. It adopted a view that government involvement was counterproductive in finance generally and in banking in particular, and that the market would do better, would be more likely to avoid financial instability, something that policymakers were relatively cavalier about because the New Deal system had been so stable for so long. And so while we had like bank failures of small banks in the 80s, we had not had a serious crisis of the whole system since 1930s. The view was, we'll keep the government out of things. It was a market liberalization agenda, and the market knows best. And the result was there was very little government expertise on hand to respond to the crisis. And so in my first 2 years in thinking about this, what I learned was that we had made a big mistake as a government in how we managed the relationship between the government and the banking system, and that there was a real need for expertise and state capacity in managing the banking system in particular. It wasn't for many more years that I figured out what I think were the causes of the 2008 financial crisis. Actually, a very simple set of causes. And still today, most people sort of talk about 2008 as this Gordian knot of, Kafkaesque problems. It's, and there's this big monster, systemic risk, and we have to go out and get it. And you never know where it is, and we're always looking for it. When actually, financial crises are relatively simple in what causes them. And the challenge is to implement the solution. And that challenge is actually more of a political challenge than it is a technical challenge.
Do you think that the Greenspan Fed, in retrospect, understood the nature of the system, but simply felt that less regulation and private sector risk balancing and competitive pressures would keep it in check? Or did they just not understand the scope of the problem? Did they not understand the evolution of the banking system and the reason why the Fed was created in the first place, like on a deep foundational level?
Well, so I think it's mixed. So it's clear if you go back and you read Alan Greenspan's speeches from the 1990s that he understood that the banking system was fundamentally changing. It was changing because of changes that he had promoted, structural changes, to allow banks to engage in vastly more complex and high-risk financial activities, and to allow them to combine and get very large and to affiliate with large broker-dealers, large insurance companies, large asset managers, to create modern financial supermarkets, something that was prohibited in the United States basically for our entire history. And so he understood that we were going to have these large conglomerates. And when he took over in 1987, and for the first 5 years of his chairmanship, the banking system was extremely diffuse. Banks were relatively simple in their business activities in terms of the mix of asset side activities they engaged in. And by the end of the 90s, the system had been completely transformed. And shadow banking, which I think we'll get to, expanded dramatically during this period. He understood that this was not what the Fed and the other banking regulators were used to overseeing. And he said, in effect, these new banks were too big to supervise, too big to oversee, that the government was not going to be able to keep up with everything that they were doing. And we needed a different model. And that model was to ensure market oversight. And so he wanted transparent markets. He wanted risk disclosures by the banks. He thought the government should focus on ensuring that the banks were disclosing risks adequately and promptly to the market so the market could engage in sort of substantive oversight of their activities. And he was shocked, I think, and he said as much, Alan Greenspan himself, after 2008, that the market failed so badly in ensuring that the large financial institutions were managing their risks properly. So that's one piece of it. I do think there is another piece of ignorance about money and banking that is an important piece of the story. In the second half of the 20th century, financial economics came to the fore, and financial economics downplayed money. It wants to see through money and treat all banks as intermediaries, borrowing from savers and lending to borrowers. And it doesn't recognize that the product of a bank is not a loan, it's a deposit. Banks are there to make deposits, and that we have a monetary system in which cash is not the primary source of money that people use. It's deposits, and banks are making those deposits. And the amount of deposits in the system is what's determining the price level and the growth of the economy. And so banks are playing this critical role. Greenspan knew about that, but it was over time, it was downplayed, that framework for thinking about the financial system and the banking system. And so I think policymakers were blind to the monetary causes of financial crises and the monetary nature of shadow banking. So they understood that bank deposits were the money supply. This was, of course, a monetarist idea that was still in vogue in the 80s. They understood that. What they were less aware of, because they weren't focused on that part of banking, was the extent to which things like repo market, Eurodollar market, money market mutual funds were basically doing the same thing, were in the same business. And they did not appreciate the extent to which the stability of the system over the course of the 20th century after the Great Depression was a product of a set of reforms to banking that these new types of banking didn't apply to them. And so Greenspan and others with a libertarian bent were very skeptical of deposit insurance. They saw deposit insurance through the eyes of sort of conventional neoclassical economic theory as something that might create moral hazard. If we insure the deposits, then they're going to take more risks. It's going to be bad. This is going to make things more difficult. Maybe it would be better off without deposit insurance. This is a terrible idea if you understand what a deposit is as a money instrument and not as a financial product.
It's ironic, too, because the first thing they did in 2008 was to expand insurance to go beyond the banking system.
Absolutely, because the thing about a money instrument as distinct from a debt instrument, and the thing about a bank deposit is it has a dual character. It's money that's backed by debt. And if you just treat it like debt in your policy thinking, then you're making a big mistake, because the thing about the money supply is we need it. We need it to be stable, and we need it to, in fact, grow over time if we want to have our economy grow over time. It's basic infrastructure. And so if the money supply disappears, we're going to have an enormous recession. It would just be like what would happen if they shut off the electrical grid for a month. If there was just no electricity for a month, that's a lot like what a financial crisis is like. And if you realize that, it's like shutting off the money grid for a month, then you're not so surprised that we had this like acute job loss in the fall of 2008, because they kind of can't function without the sort of basic infrastructure. But that framework for thinking about this was lost, and instead this way of thinking about it as debt had taken over. And yeah, there's all this hand-wringing then about supporting the money supply, but the alternative, especially once the issuers of money are starting to fail, is just a complete economic breakdown.
So I'm so excited right now because there are so many things I want to talk about. I want to pull two threads out of this conversation to really help listeners follow along and focus on what's important. Number one is the thing you were just talking about, which is what is money, the nature of money, loans versus deposits, how money is created, how it's loaned into existence, the role of the private banking system in actually creating money. I have a couple of questions related to this. And before I ask those, though, I also want to point out another thing which I think is super important that I've come to believe, and that I think was validated by reading your book, which is that there's always been, and maybe in banking more than in any other industry, this tension between regulations that are on the books that are supposed to be enforced and innovation. And in many ways, it seems to me that Bretton Woods created conflicts within the administration of the Federal Reserve System, which in some ways led to the emergence of the Eurodollar market. The breakdown of Bretton Woods similarly created conflicts, regulatory conflicts, and of course, globalization. The end of the Cold War. I don't think it's any coincidence that Greenspan was instrumental in liberalizing the banking system because there was so much demand for dollars. So those are two things that I know we'll have a chance to explore. In terms of my question, and I want listeners to know, we're also going to, as quickly as possible, go back to the beginning because I want to talk about the origin of central banking and the evolution of the Federal Reserve in particular. But with respect to what the Fed, the 90s Fed understood or didn't understand, I do remember that there was a lot of back and forth at the time about the usefulness of some of these traditional monetary aggregates. And I do remember that Greenspan basically at some point stopped updating M3. They clearly understood that the way that they were measuring the money supply didn't necessarily reflect what it actually was. So what did that tell them? How did they sort of rationalize that discrepancy?
So there was a move in macroeconomic theory during this same time to stop looking at monetary aggregates altogether. And so, interest and prices is, I think, the title of Michael Woodford's book, who's a prominent macroeconomist now. And, you would have called it money, interest, and prices. So they drop money out of it and they think, let's just look at interest rates. And now we talk about interest rate policy as monetary policy instead of money supply. It's not about the size of the money supply. It's about what the interest rates are. So we've abstracted away from money and the fact that it's being created. And that move becomes necessary when we can't keep track of who's creating the money. We actually aren't able to count anymore. When banks and the government were the only two entities, chartered government, chartered banks, and the Mint and the Federal Reserve were the only two entities creating money, you could count it all up. If no one else was permitted to create US dollar denominated money except those actors, you could count it all up and you could keep track of the actual supply. So you could monitor it going up and down. But then when all sorts of other entities that weren't chartered by the government and weren't filing reports with the government started creating money and money substitutes, you couldn't keep track anymore. The Eurodollar market, we still don't know how many dollar-denominated Eurodollars are circulating internationally. We still don't know the size of the repo market. We have estimates, but we really don't know. And so, what's the point of trying to monitor M3? What's the point of trying to add this all up and follow the money supply anymore if we just don't know how big it is? So you have to make the shift to say, we're just going to look at the price of money instead of the quantity of money because we can't count up the quantity anymore. The only thing we can keep track of is the price.
Fascinating. All right. So let's start to build up the foundation here. I want to go back to the beginning, to the origin of central banking, and have that lead us into a conversation about the origin of the Federal Reserve, because the Fed, as you rightly point out, was in some ways revolutionary within the revolutionary structure of central banking itself. So how did central banking begin?
So there's so much there to unpack. First of all, there's the concept of central banking. The concept of central banking, the term central banking, doesn't emerge till the end of the 19th century, early 20th century. And so I think it's necessary to start with the idea of a bank money system, of a public banking system. And that begins in England in 1694, when the Parliament creates the Bank of England. And so today we would describe the Bank of England as a central bank, but they would not have called it a central bank back then. They would have called it a public bank because it was a government-created bank. The goal of the bank was to augment the money supply with deposits and paper notes. The money supply at the time was coins, gold and silver, coins, and a gold and silver coin money supply. You can't control the rate of expansion very well. Yes, some people are going to be mining some metal somewhere, and that will allow the supply to expand, but it's not going to allow the supply to expand necessarily in tandem with the needs of the economy. But the idea was a publicly created bank instrumentality. And the Bank of England is an outsourcing scheme. And so at the time, in 1694, straight up and through until 1946, the Bank of England was owned by private shareholders. And the board of the Bank of England, straight up into the 20th century, wasn't even composed of bankers or financiers. It was composed of merchants. So the merchants were put in charge of deciding how many notes and deposits to add to the coin-based money supply. And that was a source of elasticity that allowed the economy to grow. It really allowed capitalism to take off. This is the secret sauce of capitalism. And so capitalism is really born in a lot of ways with the Bank of England in 1694. And so I would describe that as the first modern central bank. If we're trying to trace its origins, it's important to recognize that the Bank of England itself was copying continental European innovations of the previous 3 centuries. And so most notably, there was the Bank of Amsterdam, which was founded in the early 1600s. Difference, though, is that the Bank of Amsterdam wasn't augmenting the money supply. It was actually holding gold and silver coins in reserve for every deposit that it took and for every deposit receipt that it issued out. And so it was a mechanism for facilitating monetary exchange of gold and silver coins, but it wasn't what we would think of today as a bank or a central bank because it wasn't engaged in adding to the money supply. It wasn't involved in what we would consider monetary policy, trying to decide, do we want to expand or contract? Do we want to risk inflation or deflation? It wasn't engaged in any of that. It was truly a deposit holding facility. Venice, however, had a predecessor public bank, public transfer bank monopoly, the Banco del Giro, and that was a bank that lent to the government. It was also mostly a payments bank, though. So the Bank of England doesn't come out of nowhere. There are influences, but it's doing something really innovative, which is it's giving this private management team the ability to expand the money supply with sort of a public backing. And we would have called it a national bank or public bank. So the first Bank of the United States, which Alexander Hamilton, when the country becomes independent, the first thing it wants to have is banks because there's no gold and silver here. It's a disaster. We have real monetary problems. Shays' Rebellion is a monetary rebellion. There's just not enough money to pay taxes in Western Massachusetts. It's like you go back and you read what the founders are writing in their letters. They're like worried about not enough money. This is something we just like can't even conceive of today. Not enough money. What does that even mean? People couldn't monetize something. There were informal credit networks everywhere because you couldn't come up with the cash to actually settle the bill. And so the first thing the government does is it tries to figure out how it's going to deal with the money problem. The colonists had wanted to create paper money, banks, mints, all sorts of things in the 18th century. Parliament had forbidden it. So as soon as we become independent, we tried to reclaim that prerogative. And the solution, the approach that Alexander Hamilton wants, and that Alexander Hamilton succeeds in persuading President Washington and the Congress to employ, is to basically copy the Bank of England. So we create the Bank of the United States, which is a cousin. And it's the same idea. And the idea is we need more money. We need an elastic money supply. We don't want to have the government bringing in all the gold and silver coins and reducing the metal content in them. That's how monetary policy was conducted prior to the Bank of England, because you did have to expand the money supply sometimes to get out of debt traps. And what you would do is you devalue the coinage. We don't want to do that. We don't want the government to just issue paper notes to pay for its bills. That happened during the Revolution, called Continentals.
Not worth a Continental.
Not worth a Continental, exactly. They became worthless. And so the idea was the only way to do this was the view, the only way to do this is to outsource it to private enterprise to expand the money supply. And that's what the Bank of the United States was. And it was extremely controversial because it was outsourcing this key public function of controlling the economy and what sorts of projects get funded and what don't. And it was giving it to a bunch of wealthy investors, federalists to boot. And so there's a huge fight about the Bank of the United States. But it's a central bank. We would think of it as a central bank now, but really back then it was sort of a national bank, a public bank. It was like the Bank of England. Its charter's not renewed in 1811. We have a disastrous war with the English, War of 1812, which we are able to survive. And the Jeffersonian Democrats who are in power at this point are chastened, and they agree to create a second Bank of the United States. Because it's really difficult for the federal government to finance itself, to pay for things without a bank. And it's also hard to hold the country together. Right up until the Federal Reserve is created, a dollar isn't worth the same amount in different parts of the country. There's inter-United States exchange market. There's a foreign exchange market in the United States. There's dollars in New York. You can buy dollars in New Orleans.
Explain that. Now take a moment to explain how it was that a dollar could be worth different. I don't even know how to describe it. I mean, it's kind of like we see this phenomenon obviously in different parts of the world, but explain how it could have existed in the United States and what you mean when you say that.
So, the payment system was sufficiently poor and the money supply was sufficiently diverse that if you had money in New York,
if you had dollars that were issued as banknotes by a New York bank that had high degrees of credibility, it was worth much more than the banknotes that were issued by a bank in the middle of the country. If you didn't necessarily, especially the further you were from that, if you didn't know the bank,
exactly,
the bank's management, et cetera. But that also speaks to the fact that there was a distinction in the country at the time between banknotes and what a dollar was, right? So can you explain that? Because today people think a dollar is what the banks, they all have dollars, but that wasn't true then.
Yeah. So, a banknote was backed by a promise to pay government-issued specie, gold and silver coins. That's a very inefficient mechanism of exchange, and it's very expensive to move around. And so if you actually wanted to buy a lot of cotton, if you were in New York and you wanted to buy a lot of cotton in Louisiana and you weren't using the banking system and you were going to just pay gold and silver, you have to pay a huge amount of money to ship your gold and silver down to Louisiana. And so if you had gold and silver in New York and you wanted purchasing power in Louisiana, you had to pay for that.
Dollars in Louisiana cost you something. You had only had dollars in New York. You didn't have dollars in Louisiana. And it might cost you 5% to get dollars in Louisiana. And that continued right into the 20th century. And yeah, we now think of, you log on to Bank of America and you look at your balance. And it says $5,000. You just think that that's the same thing as if your brother logs on to his account at Wells Fargo and sees $10,000. And you think it's the same thing as the cash in your wallet. But those are all totally different forms of money. And the reason you think that is because we've been really good. The government's done a great job at ensuring that those instruments are convertible at par all the time, to the point that you've forgotten, you don't even realize that they're totally different. When you log on to Bank of America, it's 5,000 Bank of America bucks. It's not 5,000 US dollars, it's 5,000 Bank of America bucks. You just think they're the same thing as US dollars because you've never seen any scenario in which they're not. But for most of this country's history, the population would not think about it the way you did at all, because they experienced all sorts of very unpleasant circumstances where they realized quite how different a thing is a Bank of America buck can be from a dollar of coins issued by the mint.
I so empathize with your passion for understanding the monetary system because it has so many layers. And what you realize when you begin to pick at it is that the world that you understand or that you're sort of born into and operate in looks very different from the very bottom of the stack. And this is just a perfect example. Okay, so the Second Bank of the United States charter, I think, expires in 1836, I believe.
1836, yeah.
Thomas Biddle is a great, there's still, even going back to this period, there's great kind of cartoons and artwork from American newspapers. Is a great one of, Andrew Jackson like whipping Thomas Biddle out of the temple, so, and this is the other thing that's also just so fascinating, the cultural and political cross currents of money in the United States and its intersection with religion, agrarianism. You've got Thomas Jefferson, you've got Alexander Hamilton, in some sense, the dirty, soiled merchants, the sort of seedy merchant class versus the good, wholesome American agrarian farmer. Yep. All this stuff is just fascinating. But let's go up all the way now to 1913, 1914, and the origins of the Federal Reserve System, because the Federal Reserve System, as I stated in the beginning, was in some sense revolutionary. It departed significantly from what we had previously. Talk to me about how that system came into being. And when you do that, please also take the opportunity to explain how banking in the United States evolved between 1936 and 1913, greenbacks, the National Bank Act, and how that system came together, because I think that's actually important in understanding the framework for administration of the banking system that the Federal Reserve came to instill.
Yeah, I agree. So it's impossible to understand the Federal Reserve without understanding the banking system it was created to minister and stabilize. And so we have to go back to the 19th century again here. So after the second bank disappears, and there's a whole story there we could get into, but it's a tangent, money augmentation is left to the states. And so states go out and they create lots of banks. They're creating public banks. They're not regulating private banks. There were such things as private banks back then. They're chartering state entities that are going to be subject to special state oversight that are going to expand the money supply. And this is a sort of an American innovation. And it gets started right in 1799, 1800, 1801, as soon as the Jeffersonian Democrats take over. So even under the Bank of the United States system, Hamilton thought, we'll just have one big bank, the Bank of the United States, and we'll let each state. It was unclear at the beginning whether there would be like branches in each state or each state could have its own bank because the states were sovereign. So there was the Bank of New York, and would the Bank of New York just join into the Bank of the United States and become a branch, or could it continue to exist? And they ultimately were like, oh, it could continue to exist. There'll be these state banks for the state sovereigns, and then there'll be the Bank of the United States, and that's it. And when New York chartered a third bank, Hamilton was just horrified. He wrote off a letter to his friend at the Bank of New York, and he was like, this is going to be a complete disaster. We're going to have a credit bubble. This is going to cause a crisis. We can't have three banks in one city. Insane. But Hamilton lost that one. Politically, the only way to do this outsourcing was to diffuse the power. And so what you end up with is states creating a lot of banks. In the Civil War, the federal government has no bank instrumentality of its own, and it is stuck depending on the state-chartered banks. The state-chartered banks are operating in silos within states. There's no national monetary fabric. There's a panic because the government borrows all the gold out of the banks. The banks suspend payments, which means they're just issuing notes that you can't even go into the bank and get gold and silver for, or government dollars. And the Lincoln administration, they established the foundations of the modern American financial system as the National Bank Act. 1864, they actually passed the National Currency Act in 1863, which is basically the same thing. They modify it a year later. They fix some things. And the idea of that law, and that law, by the way, JP Morgan, Chase, you might have a bank account there, Chase or Wells Fargo or Bank. Those are all national banks. The law that governs those banks was passed in the 1860s. And the idea was, boy, wouldn't it be great if we could have a third bank of the United States, a government instrumentality to expand the money supply and wrangle these, more minor state players. But that's politically impossible. What we're going to do is we're going to adopt the wisdom of the Jacksonians and the Jeffersonians, and we're going to split the atom of the third bank into hundreds, thousands of pieces. And we're going to charter banks to operate within only specific localities. And we're going to coordinate the activities of all of them through an office in the Treasury Department, the Currency Bureau. And so they passed the National Bank Act, and they chartered lots of national banks instead of one national bank, lots of public banks. But the idea was it's going to be like a Bank of England split into a lot of different parts. We're going to make this politically palatable and sustainable and accountable, and we're going to adapt this to American circumstances. And what they found over the 19th century is that the Currency Bureau was totally outmatched in terms of administering this system in a way that prevented the sort of for-profit private interests of each individual bank from leading to very bad systemic outcomes. So you have these recurrent crises. And the Federal Reserve is a modification of the national banking system, an attempt to prevent the instability, the deflationary tendencies under issue of money that policymakers decided it was prone to, and to level the playing field. So, and there's a long story here, but New York banks ended up basically in the jungle emerging as the most powerful and sort of undermined the sort of political idea of diffusing the power to localities. All the other states felt like New York bankers were lording it over and controlling their bankers. And so the Federal Reserve was meant to level the playing field as well. And the key innovation, and this gets to what you, I think, referred to earlier, the key innovation, what makes the Federal Reserve not like late to the party, copying the Bank of England or something like that. The key innovation was the Federal Reserve Board of Governors, the board of the Federal Reserve, which is a public board. And so for the first time, you have an economy that had adopted a banking system like the Bank of England's, insourcing instead of outsourcing some control over it. They put some political officials in charge of this, and that was extremely controversial in 1913 when the Federal Reserve Act was passed. It was much more like central banks we take for granted today as a government monetary authority than anything that had ever existed in the United States, certainly, but also in Europe.
And, during this time, this is obviously something but there were different interest groups, obviously, both trying to control, pushing for and trying to control what central banking in the United States would look like. You had kind of the William Jennings Bryan crowd, and you had the JP Morgan crowd.
Yep.
And the importance and power of the New York banks is yet another example of the tension between the regulatory zeal of interest groups, so to speak, and the commercial interests. And that was a constant source of tension. So let's talk about, we're now in 1913. We've talked a bit about what central banking used to look like. What did what you referred to as the American monetary settlement look like in the form of the Federal Reserve? And what were the four central components of that settlement?
Yeah, so the American monetary settlement is basically what emerges after the failure of the second bank, and it is federalized during the Civil War. And it's the idea that, and I forgot to talk about greenbacks, and greenbacks are actually a very important piece of this. It's the idea that
the government is going to continue to outsource money creation. It's not going to get in the business of paying its bills by issuing paper notes. It's not going to conduct monetary policy directly. We're not going to go back to pre-1694 England when the crown would revalue the coins. The executive will not conduct monetary policy. And there was a brief period during the Civil War where the government did do its own monetary policy. They issued currency greenbacks. And these were like continentals. And that's how the government paid for the war. And that's part of how the Lincoln administration got the political votes to create the national banking system, which was a major, major piece of new infrastructure, is that there were a lot of people who preferred that to having more greenbacks. And so it looked like a suitable compromise. And so the settlement is the government's not going to do this directly. It's going to outsource. So the first prong is delegation. It's outsourcing. That money issue is done by private, specially chartered private corporations, not by the government. But then there's three other prongs that I identify that I think are key pillars of American money and banking for 150 years. And they are all efforts to make delegation economically and politically palatable and durable. And so the second pillar is separation, the separation of banking and commerce. And that dates all the way to 1694. When Bank of England was created, they wanted separation. They didn't want the bank involved in any business activity because they understood this was a monetary instrumentality with sort of special government backing and government power. And if you let it get involved in trading goods and services and business, that it would dominate and play unfairly. And it needed to be kept out of the private sphere. It was a public thing, and it needed to be kept out of the private sphere. And so the National Bank Act charters these banks with limited corporate powers. They're only allowed to engage in 5 activities and activities incidental to those activities. And those activities are like issuing notes, taking deposits, dealing in gold and silver.
Right. And just to highlight that, for example, you can't give Standard Oil a banking charter.
Yes, exactly.
Or the Pennsylvania Railroad.
Exactly. Or Amazon. And so that's separation. We're going to delegate this thing, but we don't want the people who run this thing to take over our entire society. And so we're going to limit what they can do.
A recognition of the immense power
Exactly.
that comes with having the ability to issue money.
Exactly. And this goes all the way to 1694. And this was really at the surface of the conversation for a long time. So if you go and you look at debates in the early 1700s in England, people are talking about how the Bank of England, if they have interlocking directors with the East India Company, they're going to just take over Parliament. There was a real concern that, we just have to make sure that we're going to outsource this, but we have to keep it in bounds. And William Jennings Bryan, this was a big part of his political movement, was opposing the power of this group. And so prong 3, I call diffusion. And that's what happens when Hamilton doesn't get his way. And it's the idea that really gets codified in a few states beginning in the late 1830s and then is in the National Bank Act that we're going to prevent any one bank from being that big and serving that big of an area. So not only do banks not get to be in the oil business, but they can't even be in the banking business everywhere. We can't have a second Bank of the United States again. We don't want any more Biddles. And so Louisiana will have its own banks, and New York will have its own banks, and Illinois will have its own banks. And then that will be a manageable political arrangement. And bankers will be accountable because they'll work in their own communities. And so the communities they serve will know them personally.
Let's talk about that a second. I just want to, or not talk about it, but highlight something too, because it's so important for people to understand, because it goes right back to William Jennings Bryan and the free silver movement, which is that different parts of the country had different access to credit. And credit was a source of power. Again, to the point about New York banks. New York banks had a lot of business overseas, London, and other parts of Europe. And the extent to which those network effects were in place determined the amount and availability of credit. And so having diffusion also meant that credit would be made more equally available to other parts of the country, to farmers in the Midwest, for example.
Absolutely. And this is still a problem today. We just don't talk about it as much. but where is credit available in this country? As the banking system has consolidated, there's much more credit more cheaply available in New York for financial speculation and much less credit available for business investment in many parts of the country. And this was really front and center on politics right up to the Great Depression. And it comes from the fact that a money issuing entity doesn't have to find an existing supply of money in order to fund a new project. It can create the money if it sees a project that it thinks is worthwhile. And so it's engaged in a type of governance. And if the people who are doing that are all in Philadelphia, like the Second Bank of the United States, then it gives an advantage to people who are looking to borrow from that bank in Philadelphia.
I think this is so crucial. And I actually just want to take this moment to really hammer it home, because there is such an enormous gap of understanding in the public conversation around hard money, fixed money, and the reason why money is expanded or not expanded. Because a lot of people have this idea in their minds, for example, that there's no issue with growing an economy with a fixed supply of money. But the problem isn't about the money, the fixed supply of money. It's really about the credit. And more importantly, it's about the economic opportunities that are advantaged and disadvantaged as a result of that availability of credit.
Yes.
And this is exactly what we're describing here. And I think it gets lost when we think about it in terms of gold and some fixed stock of gold where you just increase the price of gold. Has nothing to do with that. It has to do with the availability of credit and the ability to advantage or disadvantage the economic futures and opportunities of the people that reside within the territories where that credit is made available. But we were on the path of talking about those four central components of the American monetary settlement, Lev. We talked about delegation, we talked about separation, and you were in the process of completing the conversation around diffusion.
Yes.
So I wanted you to get back to where you were there.
Yeah, so diffusion, I think we covered the key idea of diffusion. And legally, the way that was represented is that banks were restricted in their ability to conglomerate, to merge, to branch, and those restrictions were ultimately removed in the 80s and 90s. And so that's why the world doesn't look like this anymore. But for many people still alive today, banking was a much more diffuse affair than we know it now. The fourth prong is supervision. And supervision is special government officials are commissioned and empowered to examine banks and their affairs and ensure that they are operating in a safe and sound manner, and that the money that they are issuing is going to be able to maintain par with government-issued cash over time, that they're not recklessly extending credit. And this dates all the way back to the 1830s, well before the development of the modern administrative state. Really, the origins of the administrative state in some ways are tax collection and money issue. And on the money issue side, it's creating all these supervisors to keep track of all these new franchisees, basically, that the government has. When you had one big bank that was full of a bunch of politically connected people, it's easy for the government to keep an eye on what was going on. When you decide to outsource and diffuse, and you've got thousands of banks, you got to have a whole bureaucracy to hold them to account and ensure that they're not scammers. And so there's a long history of bank oversight, bank regulation, what's called bank supervision, and that's the fourth prong. And the Fed is in some ways a supervisor. It is actually an enhancement of prong 4. It's an attempt to better achieve some of the goals of prong 3, but it's primarily an enhancement of prong 4. It's the idea that supervisors prior to the Fed were really focused on the microprudential soundness of an individual bank, trying to ensure that individual banks didn't fail. And we didn't have deposit insurance in these days, so when banks failed, people lost their money. And the Fed was recognizing that actually this whole system needs to be administered at a macro prudential level. And we need to have control not just over the quality of bank money. Is it sound? Is it convertible into government cash in good times and bad? But also the quantity. Is there a right amount of it? Because it turned out that the system overall had a tendency to dysfunction and underproduce money, which would create deflationary periods, which would lead to sort of vicious cycles of economic contraction where the economy would get smaller, causing more defaults, causing the economy to get smaller, and so on and so forth. And the Fed was this new type of government official who would oversee the system overall and conduct monetary policy, i.e. policy that was designed to control the ability of all the banks together to expand or contract their balance sheet. How much money are they creating in total? And that's what the Fed was created to do. And that's what it still has the tools for. And it was a very successful innovation and also very unsuccessful. So it has a very checkered and complex history. In some ways, really achieved some of the goals of its champions, and in other ways, I think it has let them down.
I also want to, that was a great summation. I also want to highlight something for listeners, which is that the four of these components, some of them strengthened, some of them weakened over time. Diffusion is a perfect example. It was strengthened with Carter Glass and Henry Steagall's sponsored legislation, which we now know as of Glass-Steagall, which was eventually stripped away with the passage of Graham-Leach-Bliley and the merger of Travelers and Citigroup
Yes.
in the late 1990s.
Yes.
So this is now where I want to take us, because it's eventually going to get us to the growth of the shadow banking system and all the dangerous things that have resulted in the crises and have put us in this precarious situation we are today. But all of that comes about in the course of the evolution of the Fed since 1913. What are those important moments in the Fed's evolution that can help listeners understand how we got to where we are today, where Fed officials don't even have a sense of what the size of the outstanding loans and so to speak, deposits, the actual dollars that exist in the world are?
Yeah. So I would say maybe there are four key moments just off the top of my head. So the first moment is 1913, and the institutional design is a public board of control. The Board of Governors is what it's now known as. Then it was called the Federal Reserve Board, which is a government agency with 7 officials appointed by the president, confirmed by the Senate, and 12 regional federally chartered banks, Federal Reserve banks, that are really operated not for profit. Their profits go to the Treasury. So that's a difference between them and the national banks that are also federally chartered. And the banks are sort of the operational arm. They are coordinating the banking systems in their districts. And during the first phase of the Fed's existence, they have a considerable amount of power. And so the policies of the Federal Reserve vary meaningfully between district. And the Fed board is overseeing these 12 banks, but its ability to control what they're doing is not as extensive as it is today. And the Fed ultimately fails to prevent the Great Depression. The Great Depression is a product of the fact that, among other things, large numbers of state banks and state trust companies didn't join the Federal Reserve System. So the vision was maybe the Federal Reserve could federalize standards in banking between the state level and the federal level. So there's been a long dream of federal banking policymakers to have a single federal regime for banking, and they've been thwarted at numerous turns. And so first, the National Bank Act, the idea is there'll be no more state banks. They'll all become national banks. That ultimately doesn't work out for a variety of reasons I think we don't have time to get into. But then the Federal Reserve Act is a second attempt. They'll all join the Federal Reserve System, so then the Federal Reserve will set a uniform standard for all of the banks in the country. That doesn't happen also, and the result essentially is the Great Depression.
I remember also when I was studying the coming together of the monetary system, I read some wonderful speeches, insightful, so to speak, speeches of officials. In particular, comes to mind Paul Warburg, who are going around the country basically lobbying state banks to try to get them to join the Federal Reserve System. And this is how it was all coming together.
Yeah, absolutely. And they were right that was important, and it didn't work. And so then you finally successfully federalize through the Federal Deposit Insurance Corporation. So all the state banks get deposit insurance after 1933 eventually. And so that eliminates the competitive imbalance, which created a race to the bottom and gaps in federal oversight, a whole bunch of things. Anyway, the second point in the Fed's history begins in 1935. The Banking Act of 1935 reforms the Federal Reserve and strengthens the board considerably and creates the Federal Open Market Committee, which is basically the beginning of central banking in the United States, in the sense that you no longer have sort of 12 banks with their independent policy. Monetary policy is set by the FOMC, and the reserve banks have to follow what the FOMC decides. And they're part of the FOMC. The reserve bank presidents have seats on the FOMC, but they have 5 seats, but they don't get to have their own policies anymore. And so that's 1935. Then there's a whole story to tell that I think is critical in the 50s and 60s, where the Fed starts to nurture and support and tolerate the emergence of shadow banks, which are just basically banks that don't have a charter and they're not regulated like banks, but they're trying to engage in the exact same business. They're trying to issue deposit money, but they call it something different. And we can get into that. That's a key piece of the evolution that it helps to understand what happened today. But statutorily, there's the fourth point is 1977, 1978, when the Fed gets its so-called dual mandate, which I think is a misnomer. We can get into that. But Congress intervenes to make some additional changes to the structure of the Federal Reserve. And, that's basically our statutory institutional framework that we still have today. And so there's no major updates made to the Fed's structure as a result of, the massive changes we're going to talk about to the banking system that take place after Second World War.
Okay, so then let's go back to William McChesley Martin's Federal Reserve in the 50s and 60s and the evolution of the euro dollar market, because this is front and center for the growth of what we call now shadow banking. So tell me what the origins of the euro dollar market are, what euro dollars are, and how this fits into this concept of shadow banking and banks that are able, or institutions that are able to issue what are effectively money-like instruments or dollars, equivalent dollar, where you could also think of it, people could think of as stable coins.
Yes.
What's the origin of that and how did that come about?
Yes. So a euro dollar is a stable coin, basically.
It's like a tether.
Yeah,
it's like a USDT.
Right.
Yeah,
absolutely right. And so let me start with the word. Euro dollar is a term of art. It has nothing to do with the euro currency or even with Europe. Euro dollars are any dollar-denominated deposit or dollar money instrument issued by an entity outside of the United States. And so a non-US bank. And so, inside the United States, if you have a deposit account, it's at a bank, the bank is chartered, it has a relationship with the Federal Reserve, the government, et cetera. But a euro dollar is, let's say, you're a bank in London, you have no connection to the US government, no connection to the Federal Reserve, and you just start maintaining dollar deposit accounts. Those dollars are called euro dollars. The reason they're called euro dollars, so the story goes, is that the first bank to really start doing this was a bank called Eurobank. It was a Soviet-owned bank in Paris. And the Soviets were wary of holding dollar balances at banks in New York because they would be subject to U.S. legal process. Their accounts could be frozen. It's a problem for the Russians right now. And so they thought, we'll have dollar balances at a bank in France. And it used to be that Eurobank would send those dollars around and they would be called they were called colloquially at the time euro dollars. Anyway, the market emerges as a sort of evasion of US legal process by China and Russia. I wouldn't even call it a market at this point. The first euro dollars start out in the 1950s like that, but it becomes a market, it becomes a thing when there is opportunity for regulatory arbitrage that is discovered. And that is that at the time, under the New Deal banking system, if you want to have deposits, you dollar denominated. If you're a European country or you're a Gulf oil state and you're earning dollars and you want to hold those dollars in a bank account, you have to hold them in a U.S. bank, and that bank is going to be subject to a lot of regulations, including deposit insurance regulations, which means that the bank has to pay insurance premium to the FDIC. That's a cost of being in the dollar business. They are subject to what was called Regulation Q, which was governments controlled the rate of interest that banks could pay on their deposit account balances. So a checking balance would earn no interest under Regulation Q. There were capital requirements. There were loan concentration requirements, all sorts of requirements. And so,
if you could run a bank outside of the US and not follow any of those rules, you could offer your depositors a little bit more interest and entice them. And that's how things really get going, especially in London. For a variety of reasons, London banks start to get in the business of maintaining dollar deposit accounts, issuing dollars. And there's an obvious problem with this business that dawns on people in the 60s pretty much very quickly, as soon as it starts to get going, which is, why do you trust that your dollar deposit at a bank in New York is money good, as they say? Because it's FDIC insured and backed by the Federal Reserve. And if you just have a stable coin issued by some random company in London with no relationship to the Federal Reserve, no deposit insurance, if you go to withdraw, are they always going to be able to redeem, or are they going to just suspend?
We're back to 1840 Wildcat Banking.
Yes.
That $1 at a bank in New York isn't equivalent to $1 at a bank in St. Louis.
Exactly.
And you can also see now, again, there's so many areas where those with experience in crypto and decentralized finance begin to see so many parallels. And that, again, to pull out the fact that there is an organic process of banking and money creation that happens commercially, and there's this attempt to administer it. And that's where we're going to move our conversation. Lev, I'm going to move the second hour to our premium feed. I want to continue this. I want to get into the origins of the repo market. Again, we still have so much to talk about with Eurodollars. And of course, there's a relationship here among all of these markets: the repo market, money market funds, commercial paper, primary broker dealers, which we don't know if we had a chance to just talk about them, but they're instrumental and essential to the origins of the Eurodollar market as well, swap lines. And I so much want to discuss the contemporary relevance of this in the moment we are today, because we've gotten hints of this in 2008, again in 2020. I don't think we're out of the woods yet. I think that's something that you write about in the book. And we'll talk about reform and what can be done to fix the system as well. For anyone new to the program, Hidden Forces is listener supported. We don't accept advertisers or commercial sponsors. The entire show is funded from top to bottom by listeners like you. If you want access to the second part of today's conversation with Lev, as well as the episode transcripts and intelligence reports, head over to hiddenforces.io and check out our episode library, where you can also become a premium subscriber today. Lev, stick around. We're going to move the second part of our conversation onto the premium feed.
Sounds great.
For more information about this week's episode, or if you want easy access to related programming, visit our website at hiddenforces.io and subscribe to our free email list. If you want access to full episodes, transcripts, and intelligence reports, which include additional notes, resources, links, and other material that will help you get the most out of each and every episode, check out our premium subscription, available through the Hidden Forces website at hiddenforces.io. Today's episode was produced by me and edited by Stylianos Nicolaou. For more episodes, you can check out our website at hiddenforces.io. Join the conversation at Facebook, Twitter, and Instagram at Hidden Forces Pod, or send me an email at dk@hiddenforces.io. As always, thanks for listening. We'll see you next week.